Hey Bowtie Nation, Joseph Hulk here with your weekly stock market update, 9 a.m. Eastern every Monday, this week on Tuesday because of the holiday, but with the stocks to watch and the stock market news you need to see. And nation stocks plunged last week with everyone pointing the finger at interest rates. But that's just the smoke, not the fire. The real reason behind the market sell-off is far more dangerous and it is about to get worse. I'm going to reveal what's really tanking your portfolio and how to invest, along with important news for shares of Nvidia and Salesforce Inc. Stick around and I'll also reveal one of the most accurate indicators for the direction of the economy. It's called the Stripper Index, and you might want to have the kids leave the room for this one. But first, back to what's really causing that stock market crash. And were it not for that tragedy that could happen to your money, the stock market could be the best drama on TV. Pundits and the financial media are falling all over themselves trying to explain the drop last week, from tariffs to inflation and interest rates. But these may be all just symptoms of a disease still worse that is developing for stocks. An issuance of Treasury bonds that saw well under expected demand last week, shooting the interest rate on the 10-year bond to 4.6%, was blamed for much of last week's sell-off. It's important because all other interest rates, from home mortgages to car loans and business financing, they're all based off the 10 and the 30-year Treasury rates. Now the market has blamed the fear of tariff-inducing inflation for the surge in rates from about 4.4% in early April, but it's not just higher prices that is driving this, and that blind spot for rates could catch investors off guard. Officials at the IRS estimate that tax revenue collected by the government could drop as much as 10% this year, as much as $500 billion less. The estimate comes from a combination of lack of staff to run audits and from a shift of taxpayer behavior, pushing every tax-avoiding scheme in the book because, well, when the cat's away. And that would drive a giant hole in the national debt, already bigger than the entire economy at $36 trillion that the government owes. Now, that warning in tax collection comes from an absolute clown show unfolding at the IRS and President Trump's decade-long feud with the agency. President Trump fired the acting IRS commissioner on April 18th, the fifth person to be fired from the job this year, and just 3 days after that April 15th filing deadline. Congress has also clawed back most of the $80 billion in increased IRS funding, and DOJ has fired thousands of auditors just before the 140 million tax returns start pouring in. Of approximately 102,000 employees at the Internal Revenue Service, 7,400 have been fired and over 4,700 have taken buyout offers. That is nearly 12% of the workforce just gone, and the organization has already started retreating from a lot of its large audits, calling lawyers for some, just asking for their best offer to settle, and in some cases, just dropping the audits altogether. Total tax revenue through last month shows an 11-figure hole and growing larger, with tax receipts $66 billion lower than expected. That includes a $15 billion increase in tariff revenue. Personal taxes are almost $100 billion under expectations. And that all brings us back to the national debt, because taxes are how the government pays its bills, and if we collect $500 billion less, those bills still have to be paid, just with more debt. Economists have been screaming about the debt since the 1980s, but it's never seemed to affect interest rates or the value of the dollar before. As in all things though, folks, the bill always comes due, and it looks like the waiter is approaching the table check in hand. The U.S. national debt was just $7 trillion in 2003, roughly half or 55% of the size of the economy, but is now ballooned to $36 trillion, more than 122% of GDP. Moody's was the last rating agency to drop the U.S. from its perfect AAA rating, a move first taken by Standard & Poor's in 2011 on those same debt worries. And it's not just that $36 trillion in debt, but where it's going. The Penn-Wharton budget model forecasts the government's budget bill making its way through Congress right now is going to raise the debt by $3 to $4 trillion over the next 10 years. It's an increase of 7% on the national debt. Congress's own Joint Committee on Taxation found the bill would increase debt by $3.8 trillion. And I know it's all a long lesson in economics, folks, but this has giant repercussions on the economy and on stocks. Plunging tax revenue collected and soaring government spending is going to mean the U.S. is going to have to borrow more at a time when it looks like those investing in treasuries just stopped trusting in the full faith and credit of the United States government. That's going to mean investors in treasury debt are going to demand a higher return on their risk, and that higher interest rate is going to choke off the economy, raising rates for mortgages and corporate bonds. So I wanted to highlight what that means for the US dollar, for stocks, bonds, and other investments, how to be ready with your money as we see this deficit disaster unfold. First, the value of the dollar is likely to keep on falling. I've already highlighted this in our March 5th update, where I recommended buying a call spread on the shares of the US dollar bear fund, that ticker UDN, which rises with a fall in the dollar. We set up a call spread here, buying the $17 call options and then selling the 18 against that for a total cost of 30 cents a share. With the dollar down 8% and the UDN now up to $18.48 each, that call spread is now worth 95 cents a share, a 216% return in just 2 months. And while I still like that dollar bear ETF, the UDN, as that dollar falls further, the easy money is probably out on this one, so you have to look further into other investments. But for stocks, those higher rates will weigh on the market with those higher debt costs hitting profits. Growth stocks are going to be hit the hardest, while stocks in utilities and consumer staple sectors probably provide a little bit more relative safety. That means look for safety and dividends in stocks like the Select Sector Spider Utilities ETF, ticker XLU, or individual names like NextEra Energy, ticker NEE. For bonds, where investors have always rushed to the safety in a recession, we could see a repeat of the 2022 crash when both stocks and bonds fell. That's because as rates increase, bond prices fall, so these might not provide the same level of safety. That said, shorter-term bonds will do better and won't fall quite as much, still providing some cushion from a market crash, so think about shifting from long-term bonds into something like the Vanguard Short-Term Bond ETF, the BSV. Gold is set to be the biggest winner from a dollar decline and has an inflation hedge, and in fact, we've already seen the price of gold hit all-time highs this year. Now, I started recommending shares of gold miners and the VanEck Gold Miners ETF, the ticker GDX, in December, now up 34% from the late last year. Central banks and foreign investors are rushing to gold and out of both the dollar and treasuries, and it's only the beginning, folks. Now, looking at the stocks I'm watching this week and a market update, Nvidia Corporation, ticker NVDA, is going to be the headline of the week when it reports after the market close on Wednesday. Shares are down about 2% for the year and basically flat for almost a year as investors digest the amazing run over the last few years. Expectations are for 65% sales growth to $43 billion, but only 20% earnings growth for the quarter to 73 cents per share as the company ramps up its spending. Earnings expectations have come down from 93 cents per share just 2 months ago, so a lot of the potential bad news is baked in here, and Nvidia nearly always beats its earnings estimates, with the average earnings beat at 7% over the past year. Now, full-year growth is still expected at 53% for sales to almost $200 billion, for a 37% pop in earnings to $4.11 a share. And if history is a clue, though, the shares could do very well, with Nvidia rising in 7 of its last 11 reports. Their shares have been up an average 10% when the market was surprised higher, and only down 3.6% when the company disappointed. There is a warning here, though, that the disappointments lately have come more often, and that upside has been lower as investors have come to expect those big numbers from the company. Salesforce Inc., ticker CRM, is also going to be closely watched when it reports earnings on Wednesday, with the shares down 16% this year and down 24% from the peak as investors worry about the AI momentum. Expectations for just under 7% sales growth and 4.5% earnings, with full year not much better at about 7.7% sales growth expected to $40 billion, though earnings are forecast up 9.5% for the year. I do really like CRM on the coming wave in agentic AI and believe there will be a time when the company surprises big on revenue, but I don't think we're quite there with shares yet. The stock is fairly expensive here at 7 times price to sales ratio for a company expected to book just 7% sales growth a year, so I would be waiting for dips to load up on this one. The stock has traded higher on 7 of the past 12 earnings reports, though there were some doozy of drops here, and the average upside has matched the average downside, just over 7% on the day. I'm also watching ZCAL, or ticker ZS, when it reports on Thursday in my favorite growth theme, cybersecurity, with the stock up 40% this year alone. Sales are expected 20% higher last quarter, on par with expectations for full-year growth, though earnings are under pressure on those lower margins. Full-year earnings are expected lower by 3.5% as that competition heats up in the cyberspace while costs increase, so investors are going to be looking more at the company's margin than at its sales growth. The company drove a big improvement in its profitability over the last year, boosting its operating margin to 20% and is guided to 21% for this year. That's helped drive that 47% jump in the stock price, but the shares are now expensive at almost 16 times on a price to sales versus an average of about 13 times price to sales ratio over the last year. Management's track record around earnings isn't great here either, with the stock rising in only 6 of the last 12 reports. Shares have rallied an average 7.8% on positive surprises, but have fallen almost 10% on some big disappointments. Now, I do own 300 shares of Zscaler, but with the disappointing earnings report from Palo Alto earlier this month and the valuation on ZS, I'm not adding shares just yet, but might if we get a big sell-off on the earnings. Showing you that big picture here before we get to our market outlook. All 11 stock sectors did fall last week, and while the traditional safety sectors like utilities and consumer staples did fall less than the growth stocks in technology and communication services, a disturbing trend here is developing in lack of winners when the market drops. A full 430 of the 500 stocks in the S&P 500 closed lower last week, a breadth of red ink that shows how weak the market really is. It is a warning sign because it shows that investor sentiment is extremely low, ready to sell out of every stock in a heartbeat, and likely means lower prices ahead. The stocks in the consumer discretionary sector are now down 6% for the year, easily the worst performing sector. Companies in that sector, apparel, automobiles, and other retailers, are going to be the most affected by the tariffs. Even with the 90-day tariff pause, the rate on most imports is still 10%, and the average effective rate is the highest in more than 100 years. According to a survey by FactSet, full-year earnings for companies in that discretionary sector are expected to fall by nearly 5%. It could be even worse. As of March, companies in the sector were expected to post 2.2% earnings growth for the year. So if trade deals are not made before that pause ends in July and August, that earnings miss could accelerate. Clearly, folks, it is not yet time to start looking for a bottom in these stocks within this sector, but it could be an opportunity soon. Economists expect the worst of the tariff pain to show up in the third quarter, which companies are going to start reporting in October and November. Right now, stocks in the consumer discretionary sector trade for a price of 27.7 times their earnings. That is 15% more expensive than the 10-year average price to earnings ratio, right around 24 times for the sector. But by the time third quarter earnings come about, valuations for stocks in the sector could be very attractive. Turning it over to our market outlook here, President Trump ratcheted up the trade war last week and spooked the market when he threatened 25% on non-US made iPhones, along with saying that he could impose a 50% tariff on imports from the EU as early as next weekend. For a market up almost 20% on that de-escalation in tariffs since early last month, it brought back the worries that import duties could drive inflation and lower corporate profits. Already, companies have warned on those coming price increases. Walmart just said frankly in its earnings report that higher tariffs will result in higher prices, and that it would be raising some prices more than double digits in May. Car makers Subaru and Ford have said that prices of some cars will increase from $600 to $2,000 each, and companies from Evenflow, Mattel, and Microsoft have all previewed price increases within the next month. We're going to see the personal consumption expenditures, that PCE measure of inflation, on Friday, though it isn't expected to show any tariff-related effects just yet. Inflation in the year through April is expected up 2.6%, the same as the previous month's pace. The odds here are for a disappointment, with prices higher than expected though, and it could spook stocks into a further drop. I'll continue to monitor inflation and other data, but there is one economic indicator that has proven to be one of the best recession warnings out there. The Stripper Index is based on the idea that cash tips to exotic dancers are discretionary, and although some guys might disagree, it's something that you're going to forego when the budget gets tight. So as a weakening economy first threatens to become a recession, it's right here with fewer guys making it rain that we're going to see the first clue. And as mentioned, it's worked surprisingly well in the past. The Stripper Index predicted the brief decline and bear market in 2022 with warnings on X from Botticelli Bimbo, and in a study actually funded by the US government, the underground sex industry foretold a recession in 2008. And this index might be flashing more than just leather and lace right now. Legal brothel revenue in Nevada has plunged 20% in just the last 3 months, and strip club revenue in Las Vegas is down 12%, warning signs that consumers and sugar daddies are getting nervous. Now, I'll be watching this one closely, maybe even doing some boots on the ground research of my own to make sure you stay ahead of what's happening in the market. I want to send a shout out to all you out there in the Bowtie Nation, and thank you for the giant milestone we passed last week. 700,000 subscribers here on YouTube, and it is all because of you. So again, thank you, and if you're not part of that community yet, don't forget to tap that subscribe button and click the bell notification.